Hi everyone, welcome to the new episode of Market Talk after a 1 week break. We had a lot of changes during this week to Fed's rate cut expectations due to fresh data from the US. We had a tense weekend as Iran responded to Israel after Israel had hit the Iranian embassy in Damascus weeks ago, remember? And we also have a busy week of earnings for the S&P 500 companies ahead. So tune in, we have a lot to talk about. So risk appetite is better this Monday than it was last Friday when the world was bracing for the Iranian retaliation on Israel. Indeed, Iran fired more than 300 drones and missiles on Israel on Saturday night, but only a small number of those reached Israel, limiting damages. So the numbers are there were no fatalities, just an army base was slightly damaged. Good news in all this is that Tehran called the operation a success and will declare that it won't take further action unless Israel responds. So oil traded slightly lower this Monday as the first reaction to the weekend news, while gold gapped higher at the open as last week's rising geopolitical tensions left a sour taste in investors' mouth. Elsewhere, base metals including copper, iron, and aluminum surged after the US and the UK decided to impose sanctions on Russian supplies. So as a reaction, spot aluminum jumped more than 5% on Monday open, while copper futures advanced also to the highest level since last summer. In currencies, well, the US dollar index consolidated this Monday after a 2% jump last week. Now, the US dollar's strength overall is mostly due to a severe deterioration in Fed's rate cut expectations since we published the last Market Talk episode. That wasn't last Friday, but the Friday before. In fact, since then, the US announced another blowout jobs data where the US economy added more than 300,000 new non-farm jobs last month. Average earnings rose in line with expectations and the unemployment rate fell unexpectedly. Then, last week saw the US CPI update surprise to the upside for the third straight month. This year, both the headline and core CPI prints in the US came higher than the market expectations. In numbers, the headline inflation advanced to 3.5% on a yearly basis, while core inflation in the US remained steady at 3.8% level. Now, some people said that the sound we heard last Wednesday after the CPI data was the door being shut on the face of the expectation of a June rate cut from the Federal Reserve. And indeed, the US 2-year yield hit the 5% level after the release of the CPI data last week, and the probability of a June rate cut from the Fed fell to around 22%. July cut expectations is around 50-50, and September rate cut from the Fed is now given around 73% chance. And well, you know the election narrative that the Fed may not opt for a rate cut this close to the November's presidential election in the US, which would then delay the first rate cut from the Federal Reserve to after the election, so to December. And some now even believe that the Fed's next move won't be a rate cut, but it will be a rate hike to tame inflation and put it back to the path toward the 2% policy target from the Fed. So expectations changed dramatically since the beginning of this year. Now, while the US data continue to cement the strength of the US economy and obviously the fact that the US doesn't need a rate cut immediately and should not be cutting the rates with such a heating in inflation and such strong economic data, while the rate cut expectations elsewhere remain pretty solid, because last week's European Central Bank meeting gave just another hint that the European Central Bank will more likely than not cut its own interest rates in June, as many ECB members already voted to cut the rates already this month. Now, the ECB chief Christine Lagarde said that the ECB is data dependent and it is not Fed dependent, and some other ECB members said that it is time to diverge from the Fed, as well, the US consumers are obviously relentless in spending, and the US government is very, very supportive as well, with Biden looking to cancel 7.4 billion US dollar in student debt loans. So to please the young voters before the November election. So, the gap between the Fed and the ECB rate cut expectations widened to the highest level this year following a dovish ECB stance last week and another set of strong jobs and inflation data from the US over the past 2 weeks, and the chatter of a further euro depreciation towards parity against the US dollar is now being back on the table. And while looking at the chart at the current levels, the RSI indicator is very close to the oversold territory in the euro dollar, meaning that the euro was sold just too rapidly in a too short period of time, and that a minor correction could be on the table. But most traders will actually be looking to sell the tops in the euro dollar moving forward on the back of, this growing divergence between the soft European Central Bank and the Fed that simply can't justify an interest rate cut this summer. And across the channel, while cable is also under a decent and a growing selling pressure, even though the UK economy gave signs of further recovery for a second consecutive month in February. So that was good news. But the Bank of England is still not expected to cut its interest rates until this fall, but they are still expected to cut their interest rates sometime this year and before the Fed, because seeing the Fed cut interest rates this year now fades away gently with every new data point that gets released in the US. Now, this is pretty much it for the central banks, and while strong set of jobs data wasn't a major concern for the US equity traders 2 weeks ago, last week's hotter than expected inflation data from the US raised a few eyebrows and sent the S&P 500 nearly 2% lower over last week. It was S&P 500's worst weekly performance since late October 2023. Then mixed bank earnings didn't help improve mood on Friday's trading session. JP Morgan tanked 6.5% on Friday as their net interest income missed market expectations and slipped from the previous quarter. That's bad, and this happens for the very first time in 3 years because investors are apparently chasing higher returns, and this reality is a real joy killer obviously among investors who were expecting to hear how much more net interest income the bank and the banks could actually gain with a delayed rate cut from the Federal Reserve this year. And similarly, deposits that don't pay interest at Wells Fargo slumped 18%. So overall, this week, the earnings season in the US gains further momentum with the rest of the US big banks, Netflix and TSM, due to announce how well they did in the first quarter of this year. The expectation is a 3.8% annual growth in the S&P 500 earnings per share in the first quarter, while profits for the Magnificent Seven stocks are expected to have risen around 38%. So another strong quarter in terms of earnings could actually slow a potential sell-off in the S&P 500 that sees the selling pressure rise on the back of these rising hawkish voices for the Fed, but a softer than expected earnings season for the S&P 500 stocks will likely trigger some profit taking at the actual levels. In cryptocurrencies, Bitcoin slumped over this weekend as rising geopolitical tensions weighed on risk appetite. And remember that the Bitcoin's halving, which happens every 4 years, is expected to happen sometime in the coming days. This week, after the halving, miners will receive the half of the amount that they were receiving for mining the Bitcoins then before halving, and this will obviously cut the new Bitcoin supply by 2. A lower supply is obviously fundamentally supportive of an asset's valuation, though we might not see a clear knee-jerk reaction after Bitcoin's halving this week, as most of it is already wildly priced in. So this is all for this Monday. I'm İpek Özkardeşkaya, and thanks for joining me today. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.